Hey, everybody, welcome to another episode of the Under the Hood podcast hosted by Stallion Capital. Today on the show, we have Gautam Kalia, who is the head super investor at Sharekhan. Gautam, how you doing?
Hi, Timmy. I'm fine, thank you. How are you?
I am doing well. Thanks so much for asking. And we are excited to have you on the show today. And we want to get right into hearing a little bit more about you, your firm, and your journey as an advisor. So, why don't you go ahead and start with a little bit about you?
Timmy, basically, I work for a BNP Paribas group company called Sharekhan. Sharekhan is a broking firm in India. It's been around for the last 23 plus years. Within the firm, I look after the mass affluent investor segment. I manage a team of over 100 investment specialists across India, catering to the needs of around 40,000 investors. I've got about 20 years of work experience. I started my career in marketing with Oracle, but very quickly moved into banking, managing wealth of high net worth individuals, Indians mostly. And then I went on to work across many organizations in India as well as the Middle East. Some names include BlackRock, HSBC, and ING. Along the way, I also got my charter. I'm a chartered alternative investment analyst from the Kaya Institute in the US. And I'm also part of the India Executive Committee for the Kaya Institute. I frequently appear on national television and I'm quoted in business magazines and journals on topics related to personal finance as well as investing in Indian market.
Awesome. And so I know a lot of people have the Kaya designation, but they'll also have CFP and they'll have a couple others. What made you choose Kaya?
When I did my MBA, we didn't have, and I was a marketing major, so we didn't really have that much emphasis on alternative investments. And then when I went into private banking and I was managing assets of wealthy individuals, there was a lot of portfolio structuring and allocations to alternative investments, and that got me interested in building an academic foundation in the alternative investment space. And I saw that as an emerging space in India. So I wanted to be ahead of the curve and make sure that I had a formal grounding in that space, and that's what really attracted me to Kaya. I had the option of trying the CFA as well, CFA charter, but I felt that that was a large overlap with what I had already done during my MBA. So that's why I decided to do Kaya.
I got you. Yeah, that makes perfect sense. And I've seen how alts have grown over the years. So you were right in assuming that it was an emerging industry. And then also you needed to get your designation because it was going to be an increasing portion of portfolios. So solid. It's grown here. It sounds like it's grown in India as well. And I'm curious, what sources are you going to kind of stay up to date with market trends and, on top of the best financial strategies?
Because I work with Sharekhan, which is essentially at its core a broking firm, we have a lot of in-house research. So I get a lot of access to that, obviously. Besides that, I'm very well entrenched in the industry. I represent a lot of manufacturers, fund managers to my clients. So they provide me a lot of research as well. Besides that, I do follow a lot of personal finance topics on social media as well as books. Because I'm naturally interested in it. I've managed money for so many clients that I can relate a lot to what is being taught and discussed on the personal finance side, and I try to emulate and practice those learnings when I go back and talk to my clients. Especially in behavioral finance, I find that topic really fascinating. So these are various sources of news and information that I look into.
Okay. Okay. Talk to us a little bit about behavioral finance. Why do you find that so interesting?
Because people are obsessed with making returns in their portfolios, and their obsession often leads them to taking decisions uh, that have the opposite impact. They're trying to
Mm,
generate superior returns, so they try to be more active, and they end up damaging. When very clearly you can play a more passive role, be a little bit lazier as far as managing your money is concerned, and you're the better for it. And that's really what I found fascinating, that it works extremely differently, because you grow up thinking, okay, you need to work hard, and if you work hard, then you'll make more money, and you'll get richer. But when it comes to investing, it's really not about working hard. It's more about hardly working and leaving leaving your investments alone and sticking the course. Because I was just doing some calculation today. Warren Buffett is at $120 billion personal net worth, and when he was 65 years, his net worth was $3 billion. And I said, okay, even if he didn't invest any money from the age of 65, and he didn't touch his portfolio of $3 billion, it essentially means a 15% compounded annualized growth rate. Over the last almost 30 years, he's nearly 95. So 15% by Indian standards, okay, it's high by in terms of dollar returns, but in INR terms, 15% is quite achievable. A lot of us are sitting on portfolios generating 20 plus percent returns. So it's possible. So really, it's about discipline and patience. Sorry. And that's really what I've learned through behavioral finance, that uh, it's something that doesn't come naturally to us, and that's why I find it fascinating.
it's such a counterintuitive point that you could, instead of working hard, you should be hardly working, and that will allow you to capture the returns and grow the wealth that you're looking for anyway. And in fact, your hard work might sabotage that. That is a really good point that frustrates a lot of people and probably loses people a lot of money. So we've heard a little bit about you and your firm. We've heard a little bit about how you're staying up to date with kind of the financial markets and financial strategies. Talk to us a little bit about the current market now. What key factors should we be paying attention to? And then what are your high level strategies to address those key factors?
Sure. So I've kept my response very specific to the Indian market, so that it provides a different perspective to your listeners. I'll talk about the Indian equity market first, the stock market, and then I'll talk about the debt market. So for the key insight that everyone seems to be missing about the Indian market, and this is especially true for investors who are based outside India, is the Indian retail investor. So basically, what's happening in the market is a less sexy version of the GameStop saga that you guys had, right? So
I see.
everyone knows what happened there, but it's something that is happening over the last 5 6 years. It's developing slowly. India has traditionally been a nation of savers, but most of our savings have been in the form of physical assets. So you have a lot of investments in real estate and physical gold. So it's and the remaining money has actually gone into fixed deposits, term deposits in banks. I'm
Yep.
guessing that's what they're called in the US. We call them fixed deposits. But what has happened over the last 5 6 years, especially with a lot of initiatives taken by the mutual fund industry? Mutual funds, I would say, are equivalent to your unit trusts. I'm guessing that's the name that you use.
Now we do have a term for mutual funds here as well. Would they be the same thing or are they different?
Yes. So basically, where you pool in all your money and a fund manager is managing everyone's money,
Yep.
right?
Yep. Yep. Yep.
Yeah, exactly. So the mutual fund industry has spent a lot of time and effort in educating Indians about investing in the stock market, investing in mutual funds. There is this rapid growth. of fintechs in India. So there's a technology revolution that is taking place that is making investments in the stock market easier for everyone. So you have a, let's say, a Robin Hood like player in the market, and you've got other disruptors coming in, offering these investments at a fraction of the cost. You have a rapid emergence of financial influencers here through social media. And then obviously COVID, led to a mass acceleration of all these trends. And when you couple this with, let's say, extended periods of low returns in real estate, as well as low returns in fixed income through the bank deposits, coupled again with high inflation. We are used to 4 to 6% inflation. It's not new to us. It's been there for the last 20, 30 years. So we are fine, with it. So all of these factors combined have really forced, in a way, the retail investor into the stock market. And once you have the Indian investor investing more and more in the stock market and they're able to generate returns, that's when they develop the comfort associated with the volatility of the stock market, which is something that they weren't comfortable with. But gradually, they're getting the knowledge and experience required to become more mature investors in the stock market. So, what is happening is that the Indian stock market was moving largely basis the flows of foreign portfolio investors. So it was the hedge funds, the institutional investors who were putting money in and out of India that were dictating the way the market moved. So they had a significant impact on how the market moved. So if you had a lot of FPIs, foreign portfolio investors, moving out money, then the market would correct. And similarly, when they put in money, the market would go up. So obviously, there was some depth and stability being provided by the domestic institutional investors as well, but it was not enough to absorb the flow in and out of the FPIs. While this has not changed, uh, uh, you know, uh, I would say completely, but there has been a structural shift in the market since 2015. So that's almost now 8, 9 years back. So this structural shift with more retail participation coming in became visible to the world in 2022 when foreign portfolio investors withdrew nearly $18 billion, but the our key index, the Nifty 50, which is the top 50 companies of the Indian stock market, that remained flat in USD terms. So you had such a large outflow, but the market didn't really collapse or fall or go down. It remained flat. And the foreign portfolio investors continue to stay out of India for the majority of last year as well. It's only towards the end that they really started pumping in money over the last couple of months in November and December. And they arrived late to the party because Nifty was up by 16% in dollar terms, about 20% in INR terms. And this was just about the top 50 companies in the Indian stock market. The next 500 companies delivered 40% plus returns in 2023. And after the 500 companies came the micro cap, which are basically companies which are 30 to 60 million dollars in market capitalization. And these companies, out of the 250 stocks in the Nifty Micro Cap 250 index, 64 stocks more than doubled in 2023. So really, there was a lot of value and return that was generated because you read only the top line number of Nifty 50 going up by 16% in dollar terms, and you say, okay, that's good. It's amongst the top 2, 3 markets in the world. But when you do a deep dive, that's when you realize that the market has actually delivered very high returns across the board, especially in the smaller companies. So people in the know, people who are actually in the market, who are tracking these companies, have made a lot of money. And so what is happening is that the retail investor is investing around $35 billion, compared to the 18 billion that the FPI has pulled out in 22. The retail investor is investing around $35 billion across through all sources into the market. And this number is expected to go up to about 50 billion over the next 2, 3 years. And this is a function of not just higher savings by the same individuals, but also the number of individuals who are now coming into the market. So there is a rapid growth and rapid financialization of the retail investor. So more and more investors are coming, and the news flow typically is generated basis what institutional investors talk about, what the larger fund allocators talk about. But this is a point which most people will end up missing. And that's why I thought it's important to highlight this. So, obviously, given this backdrop in equity, our high level strategy is that we have to first take a look at the valuation of the market. And when we do a valuation of the market, it is not cheap, but it is not stretched either. So we believe that the Indian market across all valuation metrics is still not stretched. So we are telling existing clients to maintain their equity allocation, uh, but within equity, reallocate money from small caps and mid caps to large caps, because we see a disparity there, that the small and mid caps have run up significantly, but there is still a lot of value in the large caps. So we are telling them to reallocate. The market is moving so quickly that we are already seeing a run up in the large caps as we speak over the last couple of weeks. So that is one. Second, because stock selection is becoming more important, so we're telling clients to reduce their allocation to passives and increase to active. And finally, for clients who are, let's say, new investors, we are encouraging them to invest in the market through staggered allocations or through a multi-asset approach. Especially if they have large investments to make in one shot. Obviously, with all these portfolios, we are gradually adding debt exposure and reducing home country bias, because the home country bias is extremely strong in India. Most portfolios have 98, 99% exposure to India, with hardly any exposure outside. So that's something that we are bringing in as well through hybrid and multi-asset funds. So this brings me on to my next point, which is about the debt market. Now, like I said, inflation is not new to India. We are used to 4 to 6%. So it's something that's happening in the developed world, where you have Europe and US now experiencing inflation. It's something that we are used to. And if inflation goes from 6% to, let's say, 8%, obviously it causes some difficulty for us as well. But it gradually comes back to about 5, 6%. And that's that historically we are quite comfortable with. Now, our 10-year GSEC is around 7.2%. The yield curve has moved from steep to flattish. And over the last, I would say, 4, 5 years, we've told our clients to stay at the short end of the yield curve and largely stick to accrual strategies. Uh, what we are not confident about right now is whether the Fed is going to cut rates when it says it will. We believe that there is a good chance that they may delay rate cuts, uh, and inflation may not be as easy to tame as everyone expects, because the market has clearly, especially in the US, the market has clearly run up, expecting the Fed to cut rates earlier. So we expect that to take a little bit more time to play out. And that is why we are telling our clients to add duration gradually and still stay in the accrual space, still stay in the short end to medium term of the yield curve, and not really add too much interest rate risk or duration risk, or market risk in their portfolio. So we will add duration tactically, but we are in no hurry to do that. One other factor that is obviously playing, especially in India, is that this is an election year, and we have had scenarios where elections have been lost due to food inflation. So we are sure that food inflation is going to be managed pretty well now, given our past experience. So that's one factor that we are keeping in mind when we advise our clients on allocating to debt.
Man, that was a thorough analysis of the Indian market. I feel like a very informed person on the Indian market now. And I'm curious, you mentioned a couple of things with you had some companies doubling that were in the smaller to mid cap. Is that right? They weren't
in,
in the Nifty 50, but smaller
in
to
the
mid
micro
cap
cap, in the
and the
micro
micro
cap,
cap.
which is beyond the 500.
I gotcha. I gotcha. So you had some doubling, others were doing like 40% returns. You had the Nifty 50 doing 16% returns, and you have a lot of foreign dollars coming in that used to have a very large impact, but now with the kind of retail investor coming in, it kind of offsets that impact that foreign dollars used to have. Now, with
Exactly.
retail investors, you're saying that 98, 99% of their portfolio has that home country bias. And while you're in equities, you're telling them to kind of go to the larger cap equities. And those 2 points made me think of risk. And you spoke to risk a little bit, but let's dive a bit deeper into risk. What are you doing to really mitigate that home country bias and kind of shifting them to large caps, balancing portfolios to prepare for, um, just stabilizing their portfolio?
Another thing that you'll find surprising is that many conversations around asset allocation and risk management with clients don't actually, they go out of the window because so many Indian investors are over allocated to Indian real estate. So, like I said,
Mm,
we love our physical assets, real estate and gold. And we see that a lot of clients, if you just remove the house that they live in, and you just look at the rest of their portfolio, they're still over 50% allocation to Indian real estate, right? Physical assets, right? So that is the key challenge for us as investment planners and helping our clients, especially since most of this real estate is not yielding returns higher than 5-6%. So when we look at long-term holdings of real estate, and this is mostly residential real estate, they don't cross XIRRs of 5-6%. This is including rental income. So that is the key challenge for us as far as discussing asset allocation and really managing the risk. But for many clients who are now becoming more savvy, who are recognizing the liquidity risk in real estate, they are understanding the fact that you don't have to put all the money in real estate. There we are having much more evolved conversations, and there we are taking a net worth approach. First we talk about their net worth, and then we lead them on into asset allocation. And in those scenarios we are able to focus on a few key risk management approaches. One is where we identify that the client is eager to do self financial harm. So we suggest a core satellite approach. Because you have a lot of clients who, let's say, bought a stock and that stock really did well, so they attribute that stock selection to skill rather than luck, right? And that we have to play the devil's advocate to kind of make them understand that when the market corrects, then they don't really have the tools to manage risk on their own, and then at least need to diversify away from themselves being the fund manager to more professional fund manager setups. So we
yep.
advise them to go for a core satellite approach so they can limit their exposure to their own style of investing through the satellite approach. We try to restrict their exposure to illiquid investments because that's really the tendency. Because once I make a lot of money in the Indian stock market, I want to redeploy that into real estate. That's really the tendency. So we have to uh, help the clients remember why they got into stocks in the first place, or why did they get out of physical real estate in the first place. And the third is obviously staggered investment approach. So you find a lot of enthusiastic investors who are looking at the kind of returns people are making and saying, okay, I want to remove my pension allocation and move it into the stock market. I'm getting funding from this bank, and I want to take that loan out and put the money in the stock market. So really, we're trying to talk them out of those rash decisions and essentially offer them a staggered approach into building an allocation into Indian equity. And that's one way to kind of reduce the market timing risk. One thing that I always tell my clients is something that I can't show you now, but if you look at a straight line curve and an exponential curve, there is there is a gap between the straight line and the exponential curve in the beginning, where the straight line curve is actually better than the exponential curve. And really, we think like the straight line curve. We think our investments are going to play out like the straight line curve when they actually play out like the exponential curve. So in the first 3, 4 years, a lot of, and those are the toughest, because the first 3, 4 years you don't see the benefit of compounding. It's only after the fifth or sixth year where the exponential curve reaches the point of the straight line curve and crosses it, and that it's only after that that you're able to witness and experience the benefit of compounding. And that's something that we love to remind our clients to kind of help them stay the course, because that's really the key risk. Client not staying the course as far as the original investment plan was concerned. You keep moving the goalpost, you keep changing your view, and you end up doing a zigzag when you could clearly just stay the path.
Yeah, I gotcha. So it's less managing like actual portfolio risk, and it's more like, hey, let's get you out of some real estate, let's get you into some equities that'll compound a little better, and then let's mitigate that client risk, if you will, of helping you stay to the plan so that we can get you to where you want to be. Does that sound accurate?
Yes, in fact, I just remembered an example. So many of our clients thank us because during COVID, the first 15 days in March, when uh, uh, when COVID really started impacting India and we had a lockdown, there was panic on the streets in the market, and the market fell in the second half of March by about 40%. And all the clients wanted to do was get out before they lost their remaining investments. And then the market bounced back and it never looked back. And
Mm.
it's those 15 days where we were reminding our clients, why they got into equities in the first place, and telling them to stay the course, saying that, the valuations are fantastic. You're not going to get a better opportunity, put more money in. And those clients still thank us and remember the fact that we were there by their side when they experience that. And they, most of them are really glad that they listened to us and stayed invested. So really the key risk management is managing that behavior, which is the big challenge.
I love that. I'm pretty sure it's Warren Buffett who says, when others are greedy, be fearful. When others are fearful, be greedy. So buying at that market low was a real pro move right there.
Yes.
For sure, for sure. Well, we've talked a little bit about risk management and kind of high level strategy there. We've talked a little bit about key factors in the market and high level strategy there. Now, talk to us specifically about portfolio construction. Talk to us about like kind of percentages of like, they're here in real estate at this percentage. We try to get them to this percent in equities, this percent in debt, and specifically for two options. One, we got a portfolio optimized for income, and then on the other side, we have a portfolio optimized for accumulation. So talk to us about both of those and how you construct them.
So again, I just want to bring back to the topic. By investor standards, a portfolio optimized for income is having 2, 3 physical properties that they put on rent and earn
Yep.
rental income from them, right? That is their plan. And maybe a few investments in term deposits in banks, which generate about 5, 6% net of tax. So obviously, the problem with this approach is its illiquidity, and you don't have enough diversification in risk. And then the other problem that clients end up facing in this approach, especially when it's at least their optimization for retirement is legacy. It's when their children have to take over the portfolio and then manage the portfolio properties and kind of figure out which ones to keep, which ones to sell. There's a lot of effort there. So our approach, let me just cover the one which is optimized for income. Our approach there is to create an income generating portfolio. Now, We do this with a combination of equity, debt, as well as some alternatives. And we do this in discussion with the client because the risk profile and the risk appetite varies significantly. So there are clients who are completely fine having 100% allocation to equity. They've been investing for the last 20, 30 years. They've seen all the ups and downs of the market through the great financial crisis. And they say, okay, we're not going to take any rash decisions. So we are fine with allocation. So there we try to build in a little bit of debt, maybe 10 to 20% of debt, to provide that stability. Because the key risk there is that the market corrects and you need money to survive, and that's really what we're trying to address there. Obviously, all these portfolios have emergency funds, at least 6 months funds in emergency, so that stays in the bank in their savings account, and the remaining portfolio, then the ratio is decided in consultation with the client. But typically, we go for a 60-40 approach, 60% in equity, 40 in debt, and we kind of make it aggressive or defensive depending on the comfort of the client. The key risk, like I said, is about managing the behavior of the client. If the client feels that they're going to not be able to deal with a 20-30% dip in their portfolio value, that's when we say, okay, let's reduce the equity exposure and probably build the debt. Now, within these allocations, we try to allocate some commodity exposure, some private equity exposure if they're okay with in the alternative space, especially for the larger portfolios. So this is on the income generating side. What I've noticed here, and you may find this fascinating, is that a lot of clients who don't have not really done this and they are sitting down with us and going through this entire process, they end up realizing that they can live much better. So we end up having a conversation with them about what are their biggest fears and are they financially prepared for it. And when you actually put pen to paper and you start noting down the financial impact of all these fears, many of them realize that they don't need to spend as defensively as they are or save as aggressively as they are. They can probably live a little bit better. They are wealthier than they thought they were. And they have more than enough money, there. And with just a little bit of fine tuning in their existing portfolios, they can probably travel a little bit more than they thought they could. So that's really the fun part of the job when we get to discover that along with the client. Now when we come to, let's say, wealth creation portfolios, wealth creation, did I get you right, Timmy? You talked
Yeah,
about the
yeah. Wealth creation, accumulation. Yep.
yeah. So when we talk about wealth creation or accumulation, it's a lot about the same, point that I mentioned to you earlier about the exponential curve versus the straight line curve. It's about reminding clients about staying the course. Don't move your financial goalposts. Obviously, life will get in the way. Your plans change, but you need to define what rich is and kind of work towards that rather than keep changing the plan. But there, what is happening is that most investors try to match their cash flows with their investments. So if you're a salaried individual, you're getting money every month. So then obviously the old adage of, you save and then you spend. So your credit card bill goes, payment goes, your home loan EMI goes, your mortgage payment, and your systematic investment plan into your mutual fund goes. So it's like a bill that has to be paid for your future self. You're paying that off, and then you're left with money to enjoy your life today. So that's really the approach that we take, and we find what I find fascinating here is that a lot of clients find themselves comfortable with saving more and more once they start saving because it's like a habit. And then suddenly you realize that you are getting good at it, you're getting better at it once you get more practice, and you're able to save a little bit more. So, mostly people are taking a more aggressive route, especially if they are young and they want to kind of, let's say, get rich faster, and if especially if they want to retire earlier, and probably have a second career, they want to get out of the rat race, and they kind of want to do something else that they wanted to. So for them, we typically suggest a more aggressive portfolio with more allocation to equity and more aggressive options. Uh, but otherwise, typically, again, we go for like a 70-30 mix between equity and debt. And we kind of sneak in a little bit of debt for our aggressive clients through hybrid funds, so that there is a little bit more stability in the portfolio, so that they don't end up taking wrong decisions when the market corrects. I love to remind my clients about 2008 to 2013, 6 years. The Indian stock, I'm sure you have your own stories from the great financial crisis, but 6 years of from 2008 to 2013, the market delivered less than 6% absolute returns. So you can stay invested for the long term. You can have patience and discipline, but staying invested in the market for 6 years and not seeing any return was one of the toughest periods most investors had to live through. So, and that's when suddenly fixed income looks so attractive. Suddenly fixed income looks like the best thing that could happen to you. So that's something that we keep bringing clients back to and saying that, don't over allocate to equity. Don't take a needlessly aggressive approach. It's okay to have that asset allocation, because you may be feeling that you're missing out. You have that fear of missing out because you've got allocation to debt right now, and the markets are clearly, going through the roof. But still, when the markets do correct, that's when this portion of your portfolio is going to take care of it. And then we apply the same logic to the offshore allocation, right? Saying that you look at the Indian stock market and you think all the best companies of the world are in India, but that's not true. There are a lot of large companies out there that are doing extremely well. And then we obviously talk about the Apples of the world and then get them to allocate some money to the US market as well. And that's how we get them to diversify a little bit, in their holdings, get some gold in there as well. And they're happy with the gold allocation. So we don't really have to push them too much on that.
Okay, that makes a lot of sense. Well, I noticed you mentioned alternatives in there very briefly, and the next section of the show is typically about alternatives. So, walk us through your alternative process. When you see one, how do you go about evaluating it and presenting it to a client?
There is immense potential for alternative investments in India. We have a very strong complexity bias as Indians. So we think anything that is a little bit more complex or off the beaten path has to be better,
Hmm.
right? Which is obviously a mistake, but most, I would say, sophisticated and large investors are not really impressed by the simple mutual fund product anymore, right? They say, okay, that's great. But the wealthier investors definitely have started looking at more exclusive and exotic options. And these come with a higher minimum ticket size of ranging from 60,000 US to 360,000 US. That's the minimum. And these are your hedge fund equivalents of your 2 and 20 structures or the 1 and 10 structures, depending on what asset class they're playing with. And the reason why clients are attracted to these are one is that you get access to a differentiated strategy. For example, you get a concentrated strategies of 6 stocks, right? Which a mutual fund will probably not provide because they have 50, 60 stocks in their portfolio. Or you have a long short approach or other differentiated strategies. Then obviously you have access to alternative beta, with investments in structured finance, mezzanine and growth financing, angel investing, private investment in public enterprise. The startup culture actually is very strong here. We've already got about 100 plus unicorns that are valued at over $330 billion as of May in 2022. So that piece is very strong. So that because of that news flow, it attracts a lot of investments into the new startups, and a lot of these startups are essentially replicating the successes of the US or other markets where you've already seen that cycle play out, and that same cycle is now being recontextualized for India, and being rolled out here. So that becomes another key reason. And the final reason I think for alternatives and the growth of alternatives is access to some star fund managers. So a lot of fund managers they kind of made their careers through managing mutual fund money, public money through that, and then they moved into the more alternative space and started their own fund house, started their own company, and that trend has really emerged over the last 3 4 years, and a lot of investors are then following those fund managers into the products that they offer. So what we do in terms of evaluating the different investments is we have a while you look at quantitative and qualitative measures for any selection of investment, but the fund manager and his pedigree and track record also plays a major role for us to decide arrive at the right fund. So I'll just give you a few numbers here. So the alternative investment fund space has grown at a compounded annualized growth rate of 26% over the last 5 6 years. And this, if you put in contrast to the mutual fund space, that has grown only at 13%. So the alternative investment fund space is actually expected to grow at the same rate or more at 25% plus. And if it continues down this path by 2028 or 2030, it will become as big as the mutual fund spaces today. So the mutual fund industry today is in India is around $600 billion. And that's really where the alternative investment space is headed in the next 5 6 years. So that's how rapidly it's growing.
That is very impressive. And do you think the thing driving the growth is primarily wealthier investors who are looking for that more exotic investment, or is there something else to it as well?
So definitely what has driven that growth is wealthier investors looking for the next the next thing, because they're kind of bored with the typical mutual funds. They're looking for something exotic, and some of these products have actually paid off quite well. Some of the returns in these
Yep.
products are extremely attractive. But also what is happening is that the mass affluent segment is becoming affluent very quickly. So that upward mobility is providing a whole host of these investors who are getting exposed to these options very quickly, and they are the ones saying, "Okay, well, let me try this." And in some places now, it is almost becoming a badge of honor or something to show off about that you are investing in a more exclusive product than instead
No.
of your typical run of the mill. So because you can't
Yeah.
really talk about real estate anymore, you sold off your real estate. So now you have something else to talk about.
I got you. I got you. That makes a lot of sense. And you mentioned a couple of kind of alt sections there, but are there any specific alternatives that are kind of emerging that you really like for client portfolios? And this isn't like an endorsement of them, just something you find intriguing.
Something that works for Indians is anything to do with real estate or gold, because essentially we just love those two asset classes. So if you have any product that kind of riffs off these asset classes or is remotely linked to these asset classes, the investor really gets it. He gets it very quickly. He understands it, and he's like, okay, there's a natural inclination and interest in it. So that's where you see a lot of interest by investors. Uh, I'll just give you some background. In 2005 and 2006, I was based in a city in India called Hyderabad, and I was selling apartments which are based in another city called Bangalore. So these apartments are being built in another city. I am based in Hyderabad. I am talking to clients who are Indians who are based in the US. And these US based clients are originally from the city I'm calling them from, Hyderabad. So they are buying property sitting in the US in an Indian city they've never been to, they have no connection, and they're buying these apartments over the phone, talking to me.
Wow.
So, just to give you a sense of how much we love real estate.
Yeah, that's a lot of love.
Yes, yes. So I'm talking about 2005, 2006, and So after that, it became really easy to talk to them about real estate development funds, saying that instead of putting in 100,000 US or 200,000 US in one property, you could probably invest in a basket of properties and earn the margin that the developer makes, because you're essentially financing the developer through a stock or a debt combination. And that's really something that became quite easy for them. So and all of this was happening as early as 2005, 2006. And then what has happened is that the Indian regulation has kind of become more formalized on these aspects, and they have introduced different structures. So in 2015 and 2016, more accessible structures were introduced. So sovereign gold bonds were introduced in 2015 under the gold monetization scheme. So that basically encourage investors to invest in a debt substitute for gold rather than physically holding it, digital substitute. And just to give you an example, in December 2023, this is last month, Indian investors put in nearly $1 billion worth of assets in these sovereign gold bonds, right?
Oh, wow.
Similar, yeah. Similarly, investment infrastructure trusts and real estate investment trusts were first introduced in India in 2016. And these securities are already now part of the portfolio allocation of a lot of mutual fund schemes, which are extremely popular, right? And now there are new products being developed, which will be launched soon, where you'll have fund managers managing only these securities. We're just waiting for that market to develop a little bit further and get more depth, and that's when these products will become available. And this market is already at $40 billion, right? And it's expected to grow to about $100 billion in the next 5, 6 years. So really, these are the spaces in the alternative space. Like I said, real estate and gold, right? You
Real estate
have
and
your
gold. Yep.
private equity investments, you have your early stage and late stage financing, and you have the people chasing the unicorns through these investments. But really, this is the space which is showing the holds the most promise in terms of growth.
Absolutely. Well, awesome. Gautam, we love to wrap up the show with just coming back to your firm a little bit. So, if people were really trying to tell you guys apart from other firms in India, what would they point to? What's your kind of unique selling proposition, if you will?
Yeah. So, I head the super investor department in Sharekhan, and our tagline is "Your financial freedom, your way." And I think that is really what represents us the best. It's who we are and what we strive to be. Everyone has different values, different attitudes, and different lifestyles. You are allowed to choose your investments the way you are comfortable. There is no really right or wrong in financial planning. There is no set rule, right?
Yeah.
You Some people are very happy earning 5%, and some people won't accept anything below 25%. So really, it's about choices and the opportunity cost of those choices, right? And that's really what we believe in, and that's our job as advisors, is really to help clients make the best choice by providing them all the information, and then also probably providing them with a framework for decision making once they get that information, and once they are able to take those decisions. And then it's just about helping them stay that course. Obviously our approach has been built in a way to try and minimize let's say a product push or conflict of interest, and I think that's really our key strength and differentiator.
Mm, I gotcha. And you mentioned kind of giving them a framework for decision making and helping them stay the course. I'm curious, are those two the most important things to a client relationship in your opinion, or is there something else that kind of supersedes those in that client advisor relationship for you?
So those are extremely important, but I think you can't get off on the right foot if there is no trust. So
Mm,
really, transparency is the key, and it's only by being transparent with each other that you will be able to develop trust. And once you have trust, then you can be completely open and honest about uh, conversation specifically to money, because we've all grown up being told that steer clear of conversations related to religion and money. But our relationship with clients is such that you have to be open and honest about all your thinking and feeling about your money. So you can't do that till you don't establish trust, and that comes only through transparency.
Yeah, absolutely. Transparency. I love it. Well, Gautam, thanks so much for coming on the show. If people want to know more about you, where should they go to find you?
Okay, so yeah, so you
Yep.
can get me on Twitter. I'm quite active there. I'm also available on LinkedIn under my name, Gautam Kalia. And I actually also compose and produce music on the side. So I'm known as VR Kal. I've got about 7, 8 tracks across Spotify and Apple Music. So if you're not really interested in what I have to say, maybe you are interested in what I have to sing.
Well, there we go. There we go. Gautam, thanks so much for coming on the show. And guys, thank you so much for listening. All the ways to contact him will be down in the show notes. And we'll see you guys on the next one.